Imagine this. You buy something. Later, you sell it for more money. That extra money feels like a win. Until the tax bill shows up. That tax is called capital gains tax. And most people misunderstand it. Some think it's a flat tax. Some think it applies to all income. Some don't even realize they owe it until it's too late. In this video, I'll explain capital gains tax in the simplest way possible. What it actually is, when you owe it, how much you pay, and how people legally reduce it. No jargon, no confusion. Let's start from the basics. What is capital gains tax? Capital gains tax is a tax on profit, not income. Here's the key idea. You only pay capital gains tax when you sell an asset for more than you paid for it. That profit is called a capital gain. Assets that commonly create capital gains include stocks, ETFs, real estate, crypto, businesses, and even collectibles like gold or art. If you bought something for $1,000 and later sold it for $1,500, your capital gain is $500. You are taxed only on that $500, not the full sale price. And if you sell something for less than you paid, that's called a capital loss. Losses don't create taxes. They can actually reduce them. Capital gains versus regular income. Capital gains are not taxed the same way as your salary. Regular income includes wages, freelance income, and business income. Capital gains come from selling assets. Why does this matter? Because in most Tier 1 countries, capital gains are taxed at lower rates than regular income, especially when you hold investments long term. Governments do this to encourage investing instead of constant short-term trading. Which brings us to the most important distinction: short-term versus long-term capital gains. Capital gains are usually divided into two categories. Short-term capital gains happen when you sell an asset quickly. In the United States, that means holding it for 1 year or less. Short-term gains are usually taxed at your normal income tax rate. That means if you're in a high tax bracket, short-term trading can be very expensive. Long-term capital gains happen when you hold an asset for more than 1 year. These gains are taxed at lower preferential rates. This is why long-term investors care so much about holding periods. It's not just about growth. It's about taxes. How much capital gains tax do you pay? The exact amount depends on your country, your income level, and how long you held the asset. In the United States, long-term capital gains are generally taxed at 0%, 15%, or 20%. Yes, some people legally pay zero capital gains tax. Short-term capital gains, however, are taxed just like salary. That's why frequent trading often leads to surprisingly large tax bills when you actually owe the tax. Here's a critical rule. You only owe capital gains tax when you sell, not when your investment goes up in value, not when your portfolio hits new highs, not when profits exist only on paper. If you haven't sold, the gains are unrealized. Unrealized gains are not taxed. Taxes only apply once gains are realized, meaning you actually sold the asset. This is why long-term investors can grow wealth for years without triggering taxes, capital losses, and tax reduction. Losses aren't fun, but they are useful. If you sell an asset for less than you paid, you create a capital loss. Capital losses can offset capital gains. For example, if you made $5,000 in gains, but also lost $2,000 elsewhere, you are only taxed on $3,000. This strategy is often called tax loss harvesting. It is completely legal and widely used. Special cases people miss. Some situations catch people off guard. Real estate often has special rules, especially for primary homes. Investment properties are usually taxed differently. Crypto is taxed similarly to stocks in many countries. Selling, trading, or even swapping crypto can trigger taxes. Gifts and inheritance often follow different rules, especially when it comes to cost basis. This is where many people accidentally overpay or underreport. Smart ways people reduce capital gains tax. These are not loopholes. They are legal planning strategies. Holding assets long-term. Offsetting gains with losses. Using tax-advantaged accounts. Spreading sales across multiple years. Timing sales during lower income periods. The goal is not to avoid taxes. The goal is to avoid unnecessary taxes. Final takeaway. Capital gains tax is not complicated. It's just misunderstood. You are taxed on profit, not total value. Selling triggers the tax, not price increases. Long-term holding usually means lower taxes. Losses can work in your favor. Once you understand these rules, you stop fearing capital gains and start planning around them. If this helped you, like the video. Subscribe for more simple money explainers. And I'll see you in the next one.